there'll be tax changes. There's things we should be aware of for the 2025 year. But is there anything on your radar right now that you said, maybe just keep an eye on this, keep an outlook for this for individual forms?
Well, there's something that does come to mind, Mike. We don't know for sure what changes might come in the new year, but if there is a change in government, it is possible that we could see potentially a reduction in tax rates. And if that happens either in 2025 or 2026, you might actually be better off pushing income from this year into a future year.
Right.
And I mean, it's always good to defer tax, but especially in years when tax rates may fall. So, if you're able to defer tax, either because you can defer a bonus, maybe you're expecting to receive a bonus, but you can defer it from, say, this month to January 1st. You're still going to get your cash. You're still going to get your bonus early, pretty soon. But I mean, it may be subject to tax rates that could be lower in 2025. We don't know for sure. But I think one thing is likely very for sure, and that is we're not going to see higher tax rates in 2025.
Now, if you want to send more money to the tax department than maybe you should, don't listen to this. We're talking about things you should do before the end of the year. They're all legal. This is what you're within your obligations to send as little money as possible. And the guy I've gone to, gosh, it's well over 20 years. Tim Cestnick may not want me to say that because he still looks great, by the way. Tim Cestnick, he's co-founder, CEO of Our Family Office, but a lot of people know him from writing in the Globe and Mail, for example. He's also the author of 5 books, including my favorites on tax. And I learned something, not that I learned something, I also like the delivery of it, 101 Tax Secrets for Canadians and Winning the Tax Game. Tim, first of all, we always appreciate yourself making yourself available to our audience.
Well, thanks for keeping inviting me. Obviously, somebody's listening. I don't know. My wife's not listening, but other people will. So
I know exactly what that's like, by the way. I know exactly what that's like.
Yeah, well, yeah. And I love my wife, but when it comes to tax, she won't listen to me.
Well, try it on economics. I mean, snooze fest. But great stuff. So we just want to bang through this and get people to make sure, get your piece of paper out, make a checklist. We just don't want you to forget something that you go, oh boy, should have done that. Or some little mini techniques, that kind of thing. So Tim, you've of course prepared thousands of tax forms, advised on them, et cetera. Can you give me a couple right away that you see people miss and you have to point them out, or they come after the fact, for gosh sakes, which is a nightmare?
Oh, yeah, for sure. There's a couple of things that come to mind for, say, investors, for example. Some of this is pretty basic, but we're coming up to year end. Make sure that if you want to claim any losses this year, you have to sell your investment, and the settlement date has to happen in 2024. Now that's easier than ever because settlement dates are now 1 day long. You don't have to wait 3 days for settlement, but just sell those losers before year end if you want to claim the losses. And by the way, one thing we talk about, Mike, this year is that the gains that you apply your losses against will matter this year because some gains are taxed more highly than others. So we can talk about that. But sell your losers. And also, investors should be thinking about this. If you are going to make a withdrawal from your TFSA for any reason, and you're thinking of doing that maybe early in the new year, you'd be better off doing that this month, because what happens when you make a withdrawal, you can now put the money back into your plan starting January 1st the following year. So you make a withdrawal in December, you can put the money back in as early as 3 weeks from now, 4 weeks from now. Whereas if you wait till January 1st to do it, you can't put it in for another year. So withdrawals from TFSAs for investors should be done this month as well.
Yeah, one of the things that, again, we're trying to remind people of is people get busy at this time of year. I always have to put the brakes on and make sure I've done the charitable donations I want to, because now, of course, I've got a little bit of grace period in January, but I want to make sure they're done, as an example.
And so, even if you wait to the last minute to donate, now you can donate online and do it at 11:50 p.m. if you wanted to and get your donation receipt. You could, for example, go to CanadaHelps.org.
Yes.
You do that and pick any charity in the country, make the donation, even if it's your local church or synagogue or whatever it is, you can donate to the small charities and get your receipt just before midnight.
And I've done that, by the way. If I thought I missed one or two, I've gone literally, as you say, wait, it's not midnight yet. I think I'm still okay. Let's come back to the capital gains thing. And the reason is, of course, there was a big change with the capital gain exemption inclusion rate change. Sort of one of the things that I hear from people, they say, well, they haven't even put the legislation forward.
Right.
And that's true. Where we stand with that, me as an investor, or me as someone who's got a capital gain or might want to take a capital gain.
Right. So, as people may recall, it was June 25th of this year that the capital gains inclusion rate changed, and it moved from 50% up to 2/3 for most taxpayers. The exception to that is the first 250,000 of capital gains in the hands of an individual, not a corporation, not a trust, but an individual, would be subject to tax every year at the 50% rate. So, depending on the volume of your capital gains, you might not have to face the higher rate. But none of this is law yet. However, having said that, you need to plan and treat it as though it has become law, because if and when it does become law, and I expect it probably it will be retroactive back to June 25th. So we don't want to make the mistake of ignoring the rule change. So think about that. And it should impact some of your planning going forward too. By the way, for example, capital losses. Capital losses are worth more now when you apply them against capital gains at the higher rate, the new higher inclusion rate, as opposed to using your capital gains against the
This
capital
year's,
losses, rather,
yeah,
the old rate.
old rate.
So what
Yeah.
that means is if you do have capital losses this year, but maybe your gains are taxed at the old 50% rate, you might want to save your losses until next year, or when you can use them in the next couple of years to offset higher tax gains with those losses.
Yeah, at the very least, you want to go over with, if you have a financial advisor, or maybe it was in the real estate side. I mean, there's many ways you could be collectibles, Bitcoin, the list. But,
Yeah.
if you have a financial advisor, I'm thinking more likely in a stock portfolio, don't wait. Don't phone them on, December 28th.
Right.
Get with it right now. And I've personally done that, donating shares to make my charitable donations. I've already done it, which is, I'm patting myself on the back. This is so unlike me. You know, you know, I'm
But you're
usually
right.
not right at the end, but I'm getting too close. But this year I sort of went, I want to make sure it's handled.
And that's a good point. If you are going to donate to charity, and by the way, this past Tuesday was Giving Tuesday, so you might want to think about giving before the end of the year. It does save you more tax to donate securities that have appreciated in value than to donate cash. And you can't do that as easily on December 31st. You're going to have
Yeah.
to plan that in the next week or two. Yeah.
Yeah, and get a hold of your, if it's a broker or someone in that sort of line, absolutely do it. And that's a great example of some opportunities there. The other ones that I'm talking about stuff, it's interesting
Yeah,
that
it's good.
you informed me about, and reinforced with me going back years. But again, income splitting for family members,
Yeah.
charitable receipts, and pooling them, that kind of thing.
Yeah, income splitting can still be done by the end of the year. And that's the idea of shifting income from the hands of one family member who's going to pay tax at a higher rate to someone else who will pay tax at a lower rate. Now, the easiest way to do that now, if you didn't set this up earlier this year, is if you happen to have a business, whether it's a proprietorship or incorporated business, you can pay family members for doing legitimate work in your business. You're getting a tax deduction in the business for those wages or that labor, and your spouse or your kids or whoever you're paying will now pay the tax on that. And if they're in a lower tax bracket, they may pay very little or no tax in some cases. So there's time to do that for sure. And you might also want to set things up for the new year where maybe perhaps you're not paying all the tax in the family, but you're having your spouse, if he or she's at a lower rate, or your kids also paying some tax, by setting them up on regular payroll, or if you own a business, or even by potentially doing some other income splitting tactics. There's other things we can get into, but you don't be the only one paying tax in the family.
And as you say, but also make sure that you detail it. What was the work done? How much was paid? All of those normal things, but do it is what I'm saying.
And
Have a clear record.
I've always said, Mike, that if you run a business and you're paying your spouse a salary, make sure that if CRA comes knocking and they talk to all your employees, that your employees know what your spouse looks like, that they can identify your spouse in a lineup of people. Because if your spouse is never around the business, it's hard to imagine paying them anything. So
No, that's a great tip. It's a great tip. The other one is, and I've just done this, and seriously, I'm patting you on the back because I'm going back to 101 tax savings, that I read 25 years ago or whatever, 20 years ago, and immediately wanted to review because I was never keen on paying more tax than I legally have to.
right.
And one is I'm getting a medical thing done before the end of the year. I wasn't going to, and I just literally booked it 2 days ago thinking you were coming on. You'll give me hell if I don't, try and move some of those forward. It could be a dental, depending on if you're on a dental plan, it's not as big a deal. But if you're self-employed, there's a lot of stuff. But yeah, So I move my
Any costs,
medical
and in fact,
procedure up.
and a lot of expenses that you want to think about paying for before end of the year. So that can include charitable donations, could be medical expenses, could be investment management fees, even could be um, courses. For example, if you're an employee, you may be entitled to the new Canada Training Credit. And
Hmm.
what that is up to $5,000 in your lifetime. You can effectively claim, and that will save you tax. If you're an employee, employees don't get a lot of deductions, and as long as the courses you're taking are related to your work, you can pay for those courses and get the training credit. You actually get $250 per year you can claim, and it's
Yeah.
cumulative. So you've never claimed it in the past. You can now add those years up, and you easily claim over $1,000 now. So
I hope people heard that though. It's cumulative. So if you hadn't been claiming that, you don't lose it. It just sort of stacks on. So maybe you've got $750 worth of those credits that you
yeah,
could use if you took a course, a legitimate course this year for, for
and
work
just
or
just
business.
just pay for that course before the end of the year, and that
Yeah.
that will get you that credit. Another thing to think about if you're say in retirement mode or getting close to that mode is the pension credit. So maybe you're not able to claim the pension credit today because you don't have a pension, and the CPP won't qualify for this. But maybe you don't have a work pension. Well, withdrawals from a RIF do qualify for this pension credit. So you could convert some of your RSP to a RIF before the end of the year and
Hmm.
make a $2,000 withdrawal from that
Okay.
RIF, and that would qualify for the pension credit. So you want to, transfer enough RSP assets to create that $2,000 a year, if you will, in income, which can end up being effectively tax free.
And I'm going all over the place, but consider how many areas the government is taxing us in so many ways,
Mm.
and that's what produces this. And again, something you always say, Tim, and what we're doing right now is we're consulting a professional. But if we can give you something, re-listen to this interview, say, hey, maybe I'll check out that, or maybe I'll check out this. But one, obviously, we've been talking a lot about home buying on this, on
Yeah.
this program. We identified the problem with the massive influx, the combination of record temporary visas, record immigration targets. I mean, really,
Yeah.
I don't think you needed a PhD to think, when you compared to housing starts, that was going to create a problem in
Exactly.
certain urban centers. So, but we still have the home buyers plan. So maybe just make a quick comment on that. Is there anything I need to do that way before the end of the year?
So yeah, the home buyer's plan is that plan that allows you to actually make withdrawals from your RSP to help put towards a home down payment.
Mm-hmm.
It's still a good plan. I think if I were to look for saving for a down payment on a home, I would probably use the First Home Savings Account first of all. Now it's like your RSP. You can get a tax deduction for the money you contribute. You can contribute up to $8,000 per year, and that's tax savings right away. And then you have 15 years to buy a home. If you don't buy the home, you can roll the money from your First Home Savings Account into your RSP, so it doesn't hurt you at all. It's like extra RSP room in that case. But the home buyer's plan does allow you to make withdrawals from the RSP. You do have to pay the money back over a 15-year period of time. So it's still a good deal. You are going to stifle the growth inside your RSP if you use the money for that purpose. But if you do make withdrawals by the end of this year, you have a certain period of time during which you have to then buy a home. So you have probably until October, I think it's October 31st next year to buy a home if you made a withdrawal this year. If you delay that withdrawal a little bit to early in the new year, then you extend the period of time during which you
Mm-hmm.
have to buy a home. So, I would not make the withdrawal into the home buyer's plan until you have found a place you want to buy and you're ready to make that purchase. That's probably my best advice on that.
Uh, we're talking about a lot of things that we're looking at the calendar year, because that's, for most of us, that's our tax year, December 31st. And so again, just to sum up, we want to move our expenses into this year and their income into the next year.
Yes.
That makes sense. But one of the ones that I was just wondering, knowing so many students, and thankfully they're listening to Money Talks, and they have, let's say they're paying quarterly tuition, or, they're not paying the single one-off installment because it's just too darn expensive. You might want to pay that then by the end of December if you were going to be forced to pay it in January anyways.
Yeah, that's right. So students can claim their tuition, and if you play it before the end of the year, you're going to get a credit for that. Now, when you transfer your tuition credits to your parents, if that's what you're doing,
Mm-hmm.
there's a cap on how much you can transfer. So it's $5,000 cap. Hopefully, you've got some other income of your own that will allow you to use up that tuition either this year or you can use it up carrying that forward as well. But ideally, you want to use up as much tuition as, claim as much tuition as you possibly can. So that's another one of the costs you might want to cover or pay before year end. Now, something else, Michael, people should think about doing, if you get a refund every year, so April rolls
Mhm.
around, you file your tax return, you get a refund. What you're really doing is you're getting money back that you loaned to the government free of interest. They're not paying you interest on that money. So what you might be better off doing is not getting such a big refund in April, but instead reducing any tax that's deducted from your pay, for example, throughout the year. So if
Mhm.
you have things that you're claiming every year, like charitable donations, RSP contributions,
Medical.
maybe spousal support or
Mm.
spousal support, that kind of thing. If you have deductions that you can verify, you can actually file a form right now today, so that early in the new year, the government will send you a letter back confirming your ability to have your taxes reduced, that's deducted from your pay, and you file form T1213. So form T1213, fill that out, and then you can get some hopefully less of a refund and more back throughout the year.
Yeah, I smile at what you're saying there because trying to explain, and you'd have to do it much more frequently, but for me to try and explain, someone says, "God, I got my tax refund." And I go, "That's not good news. You just lent the government money for nothing. You earned nothing on
Could have
that."
been, you could have used it in your own hands. You could have invested
Yeah,
it.
but I just smile because a lot of people don't quite get that, that subtlety, let's say. Not so
Right.
subtle, actually. Tim, let's finish with this. And by the way, again, I appreciate, and I'm going to call on you again. I love to do it while we're live here, so when we come into the new year, there'll be tax changes. There's things we should be aware of for the 2025 year. But is
Mm.
there anything on your radar right now that you said maybe just keep an eye on this, keep an outlook for this for individual forms?
Well, there's something that does come to mind, Mike. We don't know for sure what changes might come in
Yes.
the new year, but if there is a change in government, it is possible that we could see potentially a reduction in tax rates. And if that happens either in 2025 or 2026, you might actually be better off pushing income from this year into a future year.
Right.
Um, and I mean, it's always good to defer tax, but especially in years when tax rates may fall. So, if you're able to defer tax, either because you can defer a bonus, maybe you're expecting to receive a bonus, but you can defer it from, say, this month to January 1st. You're still going to get your cash, you're still going to get your bonus early, pretty soon, but I mean, it may be subject to tax rates that could be lower in 2025. We don't know for sure. But I think one thing is likely, very for sure, and that is we're not going to see higher tax rates in 2025. So that does come to mind. I think as far as capital gains rates go, if there's a change in government, I do believe we'll see a reduction in the capital gains rates. I don't know that it's going to happen in 2025. I think it's more likely to happen after that, maybe 2026,
Hmm.
2027. But that also means that if you can defer tax on the sale of some assets, whether it's a stock or a piece of real estate or something, you might be better off deferring that and not selling that at this moment, because you'll pay tax at a higher rate potentially now. If you're subject to the higher inclusion rate, that's something to think about as well.
Well, so much to think about, Tim, and we appreciate you finding time for us. And as I said, put you on the spot. We'll be visiting again soon in the new year. But
For
in the
sure.
meantime, look for Tim in the Globe and Mail, writing way too often, by the way. I was thinking, where do you get the time? But some very important subjects that you've been commenting on and educating people on. But that's in the Globe and Mail. Tim Cestnick, co-founder, CEO of Our Family Office. Big thanks. Merry
Thanks.
Christmas, too, please.
Merry Christmas, Mike.